Hey traders, this is Jeff from zentrader.ca, and I just kind of want to talk about the market action this week. But before I touch on that, I just want to kind of recap when the markets were falling here. I had noticed that bearish sentiment seemed to be pretty high, meaning a lot of people were saying how when the markets rally up, I want to get short. And I'm presuming that these were the traders who probably had missed a lot of this. And so as the markets are falling, they don't want to short here, they want to wait until the markets bounces. Well, now that the markets have bounced, I'm not really noticing a whole lot of people who are thinking the markets are gonna fall. And the reason I'm pointing this out is because this was my strategy. I knew when we were down here, I was covering a number of my shorts, and I knew that if the markets rallied higher, that would probably be a good opportunity to short. And the reason I thought that is because my market timing signal was significantly bearish, and I felt that any rally would not be enough to push it bullish. So I felt that would be a good opportunity to get short. And when you just simply look at this 60-minute chart, with no indicators, you can just see that the short-term or mid-term trend is down. You know, we've got lower highs, lower lows, and this looks like a place where we're probably going to roll over, especially the fact that this has pretty much been a V bottom off of this sell-off, and I'm just not a fan of those. Those typically fail. So it just seems like, and especially with leading stocks with Apple, that people got more bullish up here, where not when the general markets and Apple was at 505 and 510. I mean, there wasn't a whole lot of Apple bulls there, but as it rallied up, and I think Apple was actually down today. Yeah, Apple's actually down $10. So my point in saying this is it just seems like a lot of people are expecting a Christmas rally, that the markets are going to rally into the new year, and that very well could happen. I just don't think it's that's the scenario is going to play out. Let's look at the VIX here. You can see that these double red lines are an area where it's good to sell the market. Whether that means shorting it or whether that means taking some of your longs off the table, booking some profits, because generally that's, you know, in an area where, you know, let's just look here, markets fell, here markets fell, here didn't even make it all the way down, markets really fell, and I mean, this isn't given every single time. Here the markets had a sell-off. Here, the markets rallied up some more, formed some positive divergence, and then had a significant fall. Now, granted, we're not in this red, but there's a lot of room between where we're at and these green lines, which I've deemed to be the area where the markets are extremely oversold, and you might want to start dipping your toes on the long side, or even be an aggressive buyer, because the markets have typically found some bottoms there. Now, generally, when you're up here, you're going to experience some volatility, but in my experience, you're better off buying when the VIX is up here than when you are down here. This is the VIX with the actual VIX removed. You can see that we're below normal volatility. We're not down here to these low levels, but we're certainly on the wrong side of volatility if you are bullish on the general markets. The CPCE, same thing. It's somewhat complacent, and what that means is there's a moderate amount of calls being bought. Up here, this is where a lot of puts are being bought. If you go by the theory that the masses are generally wrong, then if calls, I guess this probably is not the best chart to look at. I got one more, basically the wedge that we're in. I guess there's really not a whole lot to be deemed by this, except it's moving higher.